Hi, everyone. How are we doing today?
Good.
Ready for an exam? Is that how we're feeling? Yeah. I know I talked to a few people before class and they expressed that they're extremely ready for the exam, that they wish they could have it today instead of 2 days from now. Gotta wait, unfortunately, gotta wait. But we will go through the exam and some details. I did make some changes to the study guide. I tended to make them last semester and I just completely forgot. And I also made a small change to the practice exam. I'm going to tell you, I don't think it large part will affect your studying, but I did want to clarify some things, so I did make some additions, and I'll let you know where I make the changes. But that was just my fault. They're updated on Brightspace, but again, if you're working with the old study guide or working with the old practice exam, it's not a big deal. So let's go ahead and get started. So got 12 multiple choice questions, and I believe it's going to be two problems. Two problems. One problem we already know about, I've already told you about. It's going to be the audit report, but we'll talk about that in a second. Breakdown of questions that you do need to be aware of. So there's going to be one question on the professional judgment framework. There will be 3 questions from chapter 6, 2 questions from chapter 7, 1 question from chapters 8 and 9, which if you remember, that's the question that was on sampling, or the chapters that were on sampling. And I'm going to focus very heavily on the attribute sampling stuff since we didn't really focus too much on the variable sampling. There's 2 questions from chapter 18. 2 questions from I just said 18, didn't I? I meant 2 questions from chapter 17 and then 2 questions from chapter 18. So my apologies. Both 2 questions from both chapter 17 and then 18. And then 1 question from chapter 21. For the problems, one of the problems will be on covering chapter 6 and 7, so will be related to controls. And then one of the problems will be predictably from chapter 18, the one that we already know about. It's going to be the spot the errors in the audit exam question. All right. So I'm not going to go through the stuff on the front, but you already know what's going on here in the front part. Yes.
How many questions was on chapter 7 and chapter 8 and 9?
Chapter 7 is 2, chapter 8 and 9 is 1. So front page. This is not really specific to any area. I'm not going to be asking specific questions from exam 1, but this is all supplemental information that you need to know from exam 1. If you've forgotten all this, you best reflect upon it because it's still relevant to what we're talking about today. Moreover, it will continue to be relevant as we move forward into the next part of the course. This exact page right here, the front page of the exam, will be on the study guide for exam 3 as well. So we're going to have to continue holding on to this. I tried to condense it down to the stuff that I thought was the most relevant, but please make sure you're familiar with all of this and continue to stay familiar with all of it. All right, let's move on to the new stuff. Professional judgment framework. All I'm going to tell you to focus on are these mental shortcuts, the 4 common judgment tendencies, or sorry, the 4 common judgment tendencies, these 4 items right here. Make sure you understand the definition. In particular, make sure you understand the difference between them. There gets to be a lot of confusion. I do try to provide a fairly clear signal about the question that's going to be on the exam, but it does go back to some of the things that we talked about during the lecture. So if you cannot clearly define the difference between all 4 of the judgment tendencies, I recommend you go back to the lecture that we had, and I talked about the difference and why certain judgment tendencies fall under a specific area. Okay, so I tried to give you examples for each one of those. So please make sure you review those. Chapter 6. Chapter 6. Very first thing you should know. It's kind of embedded in the study guide, but I think you all should be aware of this. Is oops, not this one. Let's try this again. Try this instead. Everybody remember that? This beautiful, beautiful diagram that I put together myself that I'm very proud because this is the highest level of artwork I can accomplish right here. So please make sure you understand what this represents. This is the crux of auditors testing and controls, which relates to how we characterize risk, which is through management assertions. So they're basically synonymous. When we identify the risk, the organization implements the control, or they identify the risk and they implement the control. And then we as auditors are responsible for testing the controls. These all 3 have to be in alignment. And this is going to continue to be relevant as we move forward. This is going to be a primary part of the areas that we're going to be talking about in the business process chapters. So please make sure you're familiar with that and understand that. Let's see, 4 objectives of COSO, 3 objectives of COSO internal integrated framework. So reporting, operations, compliance. The question was, which one is generally most relevant to the financial statement audit? Which one is it? Reporting. It's one that we spend chapter 7 talking about, so please make sure you're familiar with that. Components of internal control. You guys remember this from AIS. AIS is one of those things that I'm very, very fond of. I always ask questions about the components of internal control, so please make sure you're familiar with those. Okay, same rules apply as AIS. Could I possibly ask it for another exam, even though I asked it on 2 exams in AIS? The answer is yes, absolutely. I could, because I do think it's important to note. Let's see. So when should an auditor use a substantive strategy? That's something that's covered in chapter 6-1 slides. It's slide number 13. There were 3 criteria for that. So I'd take a look at those. You don't need to memorize those, but you should have at least a reasonable understanding of when would be appropriate to use a substantive strategy versus a reliance strategy. All right. And we talked a little bit about that. One of my favorite things to talk about with controls are these 3 items. We talked quite a bit lengthily about this. We spent like 10 minutes talking just about these 3 items. So there are limitations to an entity's internal control. These basically mean that it doesn't matter how good the controls are. These 3 things can bypass controls. Okay, so you might want to understand why that's the case. Types of evidence gathered for controls testing. This is just a reiteration of that. So make sure you understand the difference between all those and when they're used. Also, make sure you understand the technical definition for a walkthrough, not the definition that we talked about for the first exam. The first exam definition was that it was just basically a combination of all the above. We actually gave a technical definition for a walkthrough. Technical definition is you look at a transaction from its entry into the system till the time that it reaches the financial statements. So basically from beginning to end, you track a single transaction through the accounting information system and through every single control that it hits. Yeah, let's move on to chapter 7. Chapter 7, we're talking about internal controls over financial reporting. So we had 2 dimensions for evaluating control deficiencies, likelihood and magnitude. There's a pretty detailed explanation of these concepts on the 6th slide in the chapter 7 slides. So I'd make sure that you go back and review that slide. Remember, if likelihood is not at least reasonably possible, we have no control deficiency. For anything bad to happen, we have to have at least a reasonable possibility of a control deficiency. And then once we have a reasonable possibility of control deficiency, we address the magnitude. How severe is it? If it's not severe at all, it's just a control deficiency. It stays a control deficiency. If it's significant but not material, then we call it a significant deficiency. And if it's material, likely to result in material misstatement, it's going to be a material weakness. So we understand the categorization for that. Make sure you understand the steps of performing an audit ICOFR. I say this every year and it happens every year. There are 5 steps here. For some reason, this is something I actually mentioned in the chapter 7 lectures. For some reason, students tend to look at that and say, oh, he's probably not going to ask a question about that. I will absolutely ask you a question about those 5 steps. So please make sure you understand what we talked about in those 5 steps. So it's all kind of contained in here. I went into a lot more detail during the lecture. If you don't remember that from the lecture, watch the lecture. If you did take diligent notes, review those notes well. There will absolutely be questions from that section. Okay, because that's what I keep saying. And this is one of those. The reason I harp on this is one of those areas historically on the exam students have done poorly on. And my only explanation for it is that it is dense with material and people don't take it seriously as they should. So please make sure you spend some time looking at that. One of the most important areas that we can talk about is the evaluation of identified control deficiencies. That actually was something we've already talked about because that's the likelihood and magnitude analysis. Okay, again, reasonably has to be reasonably possible. And once it's reasonably possible, then we say, okay, how severe is it? That's likelihood and magnitude, how we evaluate that. So also keep in mind that we're talking about analysis. The questions that you had for homework in chapter 7 of this, you had the choice between either a significant deficiency or a material weakness. But I cautioned you on the exam, I will ask you 4 different types of possibilities. Significant deficiency, material weakness. That could also ask you a possible control deficiency, which again is at least likely to happen, but not a severe issue. And there's a possibility it could not be any deficiency at all. It means that it's a remote likelihood. So it's not, if it's a remote likelihood, then it's not a deficiency. You will have to make a decision between any of those 4 types. That's a possibility on the exam. So please make sure you're aware of that. I don't think I talked about this in the chapter 4 lecture, and I keep meaning to delete this from the slides or study guide. I'm just going to go ahead and remove that. I'm not going to ask a question about that, so let's just go ahead and cross that out. However, what's really important is this section right here. Difference between control deficiencies, significant deficiencies, and material weaknesses. Okay, so first of all, you do need to understand when do they arise, which that's the likelihood magnitude thing that I've mentioned twice now. What type of audit opinion is issued for each type of deficiency? First of all, when we're talking about audit opinion, we're talking specifically about the audit opinion on the report of internal controls, the audit of internal controls or financial reporting. This is different from the audit of financial statements. Okay, this is not talking about the financial statement audit. This is the separate opinion. So there's only 3 types of opinions that can be rendered. There's the unqualified opinion, there's an adverse opinion, and a scope limitation. Or sorry, a disclaimer opinion or scope limitation. So if we're talking about what type of opinion is issued for each deficiency, if it's control deficiencies or significant deficiencies, it's unqualified. If there's a material weakness, it's an adverse opinion. The only time a scope limit or a disclaimer opinion will come up if there's a scope limitation in the audit, okay? Which is not likely to something I go into a lot of detail about because we didn't really talk too much about that. But you do need to be aware that's another possible opinion that could be rendered. Also, who does the auditor report to regarding each of these types of deficiencies? So if we're talking about a control deficiency, we report to management. If we're talking about a significant deficiency, we report to management and who else? The audit committee. If we're talking about a material weakness, we report to management, the audit committee, and externally. It goes into our report so everybody knows about it. Also, is an important point brought up. So question came is that there's a communication made to the audit committee about control deficiencies. We as auditors have responsibility to tell the audit committee when we communicate this information to the management, but we don't actually communicate control deficiencies to the audit committee. We don't tell them what they are. All right, chapter 7, 8 and 9 sample discussion. So you're gonna notice up here, this looks different than what you had, okay? So what the differences are up here is I changed this from tolerable error and expected error to tolerable deviation rate and expected population deviation rate. Those were the terms we actually talked about in the chapter. Those are what was the update. So most important thing you need to understand is what are these concepts and how do they each of these concepts relate to sample size? So confidence level, if confidence level goes up, what happens to sample size? It gets larger, okay? They're directly related. And then tolerable deviation rate, expected population deviation rate, we're talking about the distance between those two. So if the distance becomes smaller, what happens to the sample size? Gets larger. If the distance becomes larger, the sample size gets smaller, okay? Now, you could also think about this as saying, if I hold one constant, what happens when I change the other? That's what affects the distance. So you need to think about that as well. Also, just something that I'm not likely to ask a question about, but just for context, what happens when the tolerable deviation rate is the same as the expected population deviation rate? Means we can't use sampling. Oh, sorry, I could guys sit here and say sorry. We can't use sampling because that's where we basically say that we have to test the entire population. So yeah, that was the answer, right? Whatever. You're going to go for the door, right, Dory? Okay, you're on top of it. You're on top of it. All right. Some additional sampling concept, sample deviation rate. That's easy. Divide the number of deviations in the sample by the sample size. And then how do we compute upper deviation rate? Remember, that's just the sample deviation rate plus some allowance for sampling risk. Okay, some allowance for sampling risk. Those are the most important things there. Attribute sampling, what phase of the audit is it almost exclusively used? Test of controls, yes. Remember, attribute sampling is asking a yes/no question. And test of controls is the same thing. It's just asking a yes/no question. So does an attribute exist? So we use it almost exclusively in test of controls. All right, moving to chapter 17. Subsequent event, type 1 versus type 2 event. This is very important because we talked a lot about this. What are these? Okay, so subsequent events are basically items that occur after the balance sheet date, but before the issuance of the financial statements. We as auditors have a responsibility to review them and make sure they qualify as subsequent events. There were 2 types. Type 1 are conditions that existed out of the balance sheet date. An example of that would be a lawsuit that has not yet been settled, okay? A contingent liability. Second type is a type 2 event. Type 2 event is something where the conditions did not exist at the balance sheet date. Something brand new happened. So a natural disaster or some sort of calamity, something like that, okay? So make sure you understand how we treat each of these in the current period financial statements. Type 1 means that we have to go back and retroactively restate the financials, or the client does. They have to go ahead and restate the financials to reflect the new accounting treatment. Type 2, minimum. Type 2 is going to require disclosure. It might require something more extreme, might require pro forma financial statements. So do need to be aware of possible of those. Also, this concept of dual dating, make sure you look at that. Remember, dual dating is this idea that we're going to limit liability to the auditor because we're basically only going to take liability for the specific subsequent event referenced in the dual dating of the report. Okay, going concern evaluation. So what does going concern mean? Is going concern a good thing or a bad thing? Well, going concern itself is a good thing. I'm going to try to stay at going concern as long as I possibly can. Okay. I'm shooting for another 30 years, but we'll see how that goes. Okay. Hopefully you guys are shooting for a much longer time frame. But yeah, what about substantial doubt about the entity's ability to continue as a going concern? Is that a good thing or a bad thing? That's a bad thing. It means that we're worried that they may not be in business a year from now. So what are the steps in the going concern evaluation? There are 3 of them. Okay. So the first step is basically saying, does a going concern issue exist? Does substantial doubt exist? If the answer to yes is, we move forward to step 2. Step 2 says, we talk to management and find out their plan. If we talk to them about their plan and they say, hey, we got this sorted out, and we say, wow, sounds like a good plan, I don't have any more doubt, then we move on, we just skip it. If we do still think substantial doubt still exists, that's where we move to step 3. This is a critical step. We have to do 2 things. First of all, we have to make sure that the client reports the going concern issue in their financial statements. They are legally required to do that under generally accepted accounting principles. Okay. They are required to do that under generally accepted accounting principles. Also, we as the auditors have to report this in our audit report. Now, I want to make sure the distinction. I mentioned this multiple times, but it's very confusing. If the client, oh, goodness gracious. Okay. If the client makes the disclosure that we tell them that they have to make, and we issue that substantial doubt about going concern as an explanatory paragraph, that does not change the opinion that we are going to render as an auditor. If we were going to render an unqualified opinion, we'd still render an unqualified opinion. Keep in mind, the opinion we render is about the integrity of the financial statements. The financial statements are correct. Is it possible you could have a business that is failing but still have good financial statements? Yes. Okay. So that's why that doesn't change the opinion. On the other hand, if we have a situation where the client fails to disclose that there's a going concern issue when they are required to do so, that would change our opinion because that is a departure from GAAP. Okay. Be sure you understand the difference between those two. A going concern issue itself does not require a change in opinion. Failure to disclose a going concern issue does require a change in opinion. Okay, that's the difference. Make sure you review the subsequent discovery of facts of the daily audit report. Basically, all that means is that if we go and find out that something existed during the financial statement audit that we should have audited, we have responsibility to go and review it. If we cannot review it, if the client does not allow us to do it, then basically we have to take 3 steps. First step, so we tell the client, you can't use our report anymore. So there. And then second step, we got to report to any relevant regulatory agency, which for publicly traded companies is usually the SEC. And then finally, we have to notify all stakeholders we know that are relying on the information in those financial statements to tell them that the financial statements are incorrect. All right. Chapter 18. So 8 elements of the standard unqualified audit reports. I'm going to tell you right now, straightforward, if you know those 8 elements, you probably get 6 out of 12 on the audit section, or the audit report section of the exam. I do not think it's sufficient just to know the names of the elements and what those components are. I do think you need to know the contents of those elements. So learn the report. I'm not saying memorize the report, but you should learn the important components of the report. We talked about them at length. If you don't remember, go back and watch the video because I pointed out certain stuff and says, here's what you should be looking for in this section. Here's what you need to pay attention to. Okay. I'm not going to ask you about little wordings. Like I'm not going to remove the word the and say, oh, you missed the word the. Yeah. If it's something that I remove wording for, it's going to be a big section. It's going to be a very important section to the audit report, something you should identify. Okay. So you need to be working for very prominent wording, and you need to know what that wording plays. This will be, like I said, 12 points on the exam, so 20%. So you probably don't want to lose 6 points because that's like 10% of your grade right there. So you want to spend a lot of time focusing on this. Moving on past the this is the standard unqualified report. You do need to be aware that for the standard unqualified report, there are a lot of different adaptations. So learning the standard unqualified report is not sufficient on its own. You will need to learn about the deviations to that. So that includes the different opinions and the different situations where we would change the wording. So the modified wording only exists in one circumstance. That is when we, as the primary auditor, have to work with another auditor, but we're not willing to take responsibility for their work. So we're the primary auditor. We have a secondary auditor that's done work in another part of the audit. We think they've done a good job, and then we think that their work is sound, but we're not willing to personally hold liability for their work. If they did something wrong, we want them to be accountable, not us. If that's the case, we do have to add modified wording to the opinion or to our opinion, saying based on our work and the work of other auditors. That's basically all there is to it. Where does it go in the unqualified report? It goes into the opinion paragraph, the basis for opinion section, and also we have to add an explanatory paragraph. Circumstances requiring an explanatory paragraph. So there are 4 common situations which an explanatory paragraph comes up. So again, you might want to review these because they were all relevant. The most prominent one is going to be the additional paragraph on the audit of internal controls over financial reporting. So if we did both an audit of financial statements and an audit of internal controls over financial reporting, our financial statement audit report has to contain a paragraph that says that we also performed an audit of internal controls over financial reporting. By the way, in the practice exam and in the exam I'm going to give you on Wednesday, this paragraph will not be present. I actually say that in the problem. I say I deliberately excluded it. It would normally be present in all versions of the report. I just removed it for purposes of saving space, okay? But it is a pretty standard inclusion on financial statement audit reports. Second situation, an explanatory paragraph could come up. That would be a substantial doubt about the entity's ability to continue as a going concern. If a going concern exists, and we have substantial doubt, the going concern issue exists, and we have substantial doubt, we do have to issue an explanatory or add an explanatory paragraph stating that. All right, third situation. Third situation is a lack of comparability between periods. Now, anything that affects comparability can result in a financial statement, or sorry, result in a change in the audit report. Normally, we would do the same thing as we would do for rules under GAAP. So like a change in principle, a change in accounting principle, a change in reporting entity. Anything that would basically require a retroactive adjustment would also require a change to the audit report. It is possible that a change in estimate could result in an explanatory paragraph if we think it has a material effect. Basically, if you're comparing the previous year to the current year and you think users will not be able to effectively look at certain numbers, compare them one-to-one, that would be a lack of comparability issue. That's where we would issue an explanatory paragraph. The final one is basically any other matter that we think might be relevant. So something that we think is important that we want to bring attention to, we can include an explanatory paragraph for us. All right. Conditions for departure from the unqualified report. We have 3 different opinions that are 3 opinions other than the unqualified opinion. The first of these is qualified. This can come up if we've got a departure from GAAP that is material but not pervasive. The second one is a scope limitation that is material but not pervasive. So departure from GAAP, scope limitation. Then we have our disclaimer of opinion. Disclaimer of opinion is saying we are not issuing an opinion, okay? That comes up when we have a pervasive scope limitation. What is the other circumstance in which it might come up? The lack of independence from the client, okay? An auditor is not allowed to issue an opinion if they're not independent from the client. This will never happen in publicly traded companies because you just can't audit a company if you're not, can't audit the company if you're not independent, but it might come up in other situations. And then we have an adverse opinion. This is a pervasive departure from GAAP, a massive departure from GAAP. It's basically saying the financial statements are not free from material misstatement. So it goes without saying that you need to learn that standard unqualified report. You also need to learn how are these reports changed from the standard unqualified report for each opinion type. 3 of them are very, very easy. The qualified reports and the adverse reports, those are all real easy. There's minimal changes. The disclaimer of opinion report has massive amount of changes. So you're going to have to spend some time focusing on that. All right. That's the most important things that are talked about. Again, please devote sufficient time to looking at the reports. I'm telling you 100% chance there will be on the exam, okay? And it's going to be very, very similar to the ones in the practice exam. If you felt comfortable with one in the practice exam, you should feel good where you're at. If you were like, I'm not sure what I need to do on this practice exam, you got some work to do, okay? Chapter 21, I already told you chapter 21 is going to be minimal coverage. It's one multiple choice question. Let me tell you specifically what I think you should focus on. I think you should focus on this part right here that says be able to know the assurance, level of assurance, attestation, risk, type of report, and report distribution for each type of engagement. That was the first table that we talked about in our slides. I would also make sure that you know which type of engagements align to each type of attest service. That seems like a lot because there's 6 different items, but you'll find out it's actually pretty straightforward. It's pretty intuitive and pretty sensible. You use examination for most of them. The only one you don't use an examination for is agreed upon procedure. And then if it's a more subjective particular type of engagement, then they usually require reviews. If it's less subjective, they require agreed upon procedures. Okay. Final thing I'd talk about is for each category of assurance services, be able to identify whether independence is required and whether reports required and level assurance provided. So make sure you know the definitions for each type of assurance service we talked about and understand, is independence required? Is a report issued? And do we issue an opinion? Those are basically the items that you need to know for that. And there was a table issued for that as well. So basically, if there's a table, make sure you look at it. That's all there is to chapter 21. Make sure you review the additional EWC. We only did one EWC assignment for this last section of chapters, but it was a good one. It was the test of controls assignment, which I think tied a lot of our concepts about how to test controls together. Obviously, controls are a big part of this exam, so I want to make sure that everybody's familiar with what is the testing procedure. And that was a very applicable example in the situation. All right. Anything on the study guide that I did not cover that you really want clarification on? Anything that you don't want clarification on, but you feel you need for the exam? That's probably a better question, isn't it? Yes, I don't want to clarify. That's just more information, Dr. Barnes. Give me less information. It's okay. It'll be over in 48 hours. Okay. All right, let's go ahead and look at the practice exam. Okay, so this is a professional judgment framework question. Auditors may be prone to rely on evidence that is consistent with their pre-existing beliefs and expectations. What type of judgment tendency is described above? So if you basically you already have a belief about what something should be, and you only look for evidence that is consistent with that belief, what does that sound like? That's confirming what you already believe. That's confirmation bias. Okay. Real problem in auditing is that we really want everything to be okay. If there's a misstatement, we don't like misstatements. We want everything to be good. And so we basically say, okay, I believe that this account is fairly stated, and then you find a misstatement. So I'm just going to ignore that. It's a bad thing. Okay. You can't ignore misstatements. So we do have to make sure that we're not prone to confirmation bias or any of the other tendencies that we list there. According to the Sarbanes-Oxley Act, Section 404 of the Sarbanes-Oxley Act, what is an auditor's primary responsibility with respect to a client's internal controls? So let's just go through these. Design and maintenance of internal controls. No, who's responsible for that? Management. Implementation of internal controls. Who's responsible for that? Management. Understanding and assessment of internal controls. I hope that's it, because the last one's all of the above, and we know all of the above is not correct, okay? So understanding, assessment, of internal controls. Is anybody just waiting for bated breath for that all of the above to finally trigger? It's just like AIS. I use it like 1 out of every 4 times, 25%. So you have to know it. But understanding, assessment, of internal control is the correct answer. All right. Assessing control risk at a lower level than high most likely would involve what? So this is an interesting one. And so you have to think about, first of all, this is saying that we have to use a reliance strategy. That is the condition in which we would assess control risk lower than high. So reliance strategy implies that we have to do what? What are we required to do when we're relying on internal controls? We have to have an understanding, but more specifically, we have to test internal controls. We have to understand and test internal controls. So we're required to test internal controls when we do a reliance strategy because we're relying on those controls, so we want to make sure they're correct. All right. So do we have a diagram that can help us with understanding of the process for testing internal controls? No. Michael says no. I disagree. This lovely work of art says that there is a diagram here, okay? So what do we say at the very beginning here? Say we identify risk, but how do we characterize risk as auditors? Management assertions. So would it be fair that we're identifying specific assertions to rely on? I think that's a fair assessment. That's what it tells us. So identifying specific internal controls relevant to specific assertions. That's what the diagram is saying. Because again, remember, a control is a response to a risk. The way that we characterize risks in an audit is we say management assertions. So therefore, controls are relevant to certain assertions. That's what this control sequence tells us. Let's just go through the other answers. Let's say that you had no idea. You were just kind of like saying, I ignored Dr. Bard's beautiful art because I hate the man. Okay. Let's just say that you did that. Let's go ahead and do process of elimination. So if we're going to change controls to a lower level high, will we change the timing of substantive procedures by more testing, by performing more substantive testing at interim? If we test it at interim, does that give us more or less assurance? Less. We want higher assurance if we're going to make control risk lower. So the opposite would be true. We would actually shift to year in. Performing less extensive substantive procedures with smaller sample sizes than originally planned. Again, same question. Is this test, does C imply more or less assurance? That's less assurance. We need more assurance, okay? Reducing inherent risk for most of the assertions relevant to significant account balances. Okay. Can we as auditors affect inherent risk? Can we just say, you know what? I don't feel that this is a big risk. I'm just going to go ahead and reduce it. Yeah. I just want to reduce the inherent risk. What do we know about inherent risk and control risk? They are functions of the entity and its environment. They are out of the control of the auditors. We assess an inherent risk. We assess control risk. We can't actually set the level of inherent risk or control risk. Okay. So this is not saying reducing the assessment. This is saying reducing inherent risk, which we can't do. So by process of elimination, B is the only one that makes any sense. Which of the following is a reason of testing a specific control might take place interim? What did we just say in the previous question? Interim testing provides more or less assurance? Less. So we're going to be talking about a situation where we need less assurance, okay? So the assertion related to the control tested is significant. Does that sound like something we would want less assurance or more assurance for? More assurance, okay? So A is out. External auditors are generally busy year in than interim. That's a pretty logical conclusion. That's one reason why we might want to do it. So we're going to say, all right, we're busy at year end. So let's identify some controls that we can get out of the way, some low hanging fruit that we can make sure we're done with. Testing controls and prior audits have found the controls to be ineffective. That would be a problem. If the controls are ineffective, we want more assurance of those controls because we have to make sure they're effective. All right. Testing at interim provides more assurance than testing at year end. That's inconsistent with that. So the interesting one about this one is the same issue as above, is that even if you didn't know the answer, as long as you knew that testing at interim provides less assurance, you can eliminate A, C, and D, which gives us B. All right, Casey Staden, CPA, is conducting an audit of internal controls over financial reporting in unison with our annual financial statement audit of Isaac Eisen Industries, or 4I. Which of the following would not be one of the steps that Casey would follow in identifying which controls to test for our audit of 4I Zycoffer? Okay, so we're actually talking about identification of controls. So this is a phase question. So we're trying to say, she's trying to identify which controls she wants to perform or she wants to test, all right? So what phase of the audit are we in? Talking about, sorry, go ahead.
Second.
Yeah. Yeah, so we're basically identifying controls to test. We're in the second phase of the audit, okay? So if that's the case, would we identify entity level controls? Yes, that would be the first thing we talked about. We identify significant accounts? Yes. Would we want to understand likely sources of misstatement? Yes, those are all three things we talked about in that second step, as Sadie pointed out. So which would we not do? We would not form an opinion of the effectiveness of 4I Zycoffer. Now, let's say you didn't follow my advice and get all those 5 steps down the way I told you to. Does it make intuitive sense that we would form an opinion at the beginning before we've tested anything? No, okay? We form the opinion after we've done all our testing. So A is the odd one out anyway. All right. Casey Staden has concluded her audit of over 4I Zycoffer. One noteworthy item came to Casey's attention during the audit. She concluded this item constituted a significant deficiency. To which party should she report her findings? Okay, so let's just review. If we're talking about a control deficiency, we report to management. If we're talking about a significant deficiency, we report to management and the audit committee. Good. And if we're talking about a material weakness, we report to management, audit committee, and external stakeholders. Okay. By the way, if it's not a control deficiency, do we need to report to anybody? No. Okay. So if you notice here, this is kind of an alignment. This is control deficiency. This is significant deficiency, which is why B is our answer. This is material weakness, and this is no control deficiency whatsoever. Okay, so they align with our 4 items. As part of our testing of internal controls for our financial reporting, Casey Staden employs selected attribute sampling techniques. Which of the following adjustments to Casey's inputs would most likely result in Casey having to increase the size of her sample, which I've got a parentheses here, but no opening parentheses here. So weird. Okay, assuming all of our other inputs remain the same. All right, so we're talking about something that would increase the size of our sample. So what is likely to increase the size of the sample? There's two criteria. If we have a higher confidence level, or if we have a smaller distance between tolerable deviation rate and expected population deviation rate. So each one of those is consistent with that. Now, again, this is assuming all of the inputs remain the same, so we could actually figure out the different changes in population deviation rate, tolerable deviation rate. So first of all, let's go through A. Population, is that going to make a difference? No. Larger population would only make a difference if it's a really small population of tests. Once we get to a certain level, it doesn't make a difference whatsoever. Larging sampling risk. What do we know about sampling risk? What's its relevance? If I subtract it from 100%, what do I get? I get confidence level, okay? So if I get a larger sampling risk, what does that mean about my confidence level? Smaller, okay? A smaller confidence level results in a smaller sample size, okay? Smaller expected population deviation rate. Okay, so tolerable deviation rate is here, expected population deviation rate is here. My population deviation rate goes down. What happens to the distance between those two items? Gets bigger. When that distance gets bigger, what happens to our sample? Gets smaller, okay? So it's not C, it must be D. So here, I make tolerable deviation rate smaller, the distance becomes smaller, our sample becomes larger, okay? So that's the logic that we use there. So D is our answer. In addition to her role as a top-notch auditor for 4i, Auditor Casey Staten also provides attestation services for clients. In a recent client engagement, Casey made the following statement or attestation report. We are not aware of any material modifications that should be made. What type of language is that, by the way? That is negative assurance, okay? So we know that. Based on this above language, what type of attestation engagement did Casey perform? So if it's negative assurance, there's only one type of engagement we've talked, actually technically two we've talked about, okay? But one of them's not listed here, okay? So the one that's not listed here is we talked about a compliance audit, but we don't have a compliance audit listed here. So it has to be what? Has to be a review, because a review is the other one that we use negative assurance on. We use limited assurance, negative assurance language. Good. Question number 9. Casey statement is included or testing for financial statement audit 4i as part of her testing. Casey must perform procedures to identify potential contingent liabilities that improperly accrued or disclosed. Which of the following procedures would be least useful for this task? Okay, so let's go through the answer. So expecting documentation. So inspecting records and documents on guarantee arrangements. Would looking at accounting records be effective in this regard? It's one of the things that we talked about we could identify. So yeah, A would be good. What about reviewing minutes of board of directors meetings? Let's jump to C. What do you guys think? So C would be good. I think we could actually rely on the shareholders or the board of directors to have some information on that. Could we send confirmations to 4i's financial institutions? Yeah, that was one of the procedures we talked about. All right. What about a legal letter? Sending a letter to inquiry to the 4i's attorneys. So what do we know about that? It is good for what type of information? Corroboration of information. So making sure that we can verify the information we already have, but is it good for identifying information that we don't know about? No, so it's going to be our answer. Issuing a letter of audit inquiry to the 4i's attorney, good for corroboration, not so good for obtaining information. Regardless of what the slide said, this is one of those ones where I had added additional information. So if you read this in the slide, say, Dr. Barnes, this is in the slides. I said, yes, but I added a caveat because that was a word from the book. I told you that you can only use this corroboration points. We actually talked about it in homework. Prior to the issuance of Casey Staten's audit report, 4i settles an outstanding lawsuit for an amount different from that recorded as a contingent liability of the audit financial statements. What steps should Casey insist the 4i take with respect to this settlement? Okay, is this a subsequent event? It is, in fact, a subsequent event. What type of subsequent event is it? So it's type 1 subsequent event. There's only one thing that we do for a type 1 subsequent event. What is that? Restate the financials, okay? They have to make an adjustment. So adjust the audited financial statements to reflect the settlement of the lawsuit. Easy peasy, lemon squeezy. There we go. As part of the auditing procedures for one of its important subsidiaries, 4i has engaged a secondary auditor to perform necessary testing. Casey Staten has reviewed the work of the secondary auditor and is satisfied with the quality of its work. However, she is unwilling to take responsibility for the work of the secondary auditor. How dare she? Assuming that Casey issued an unqualified report on audit of 4i's financial statements, what changes would be necessary for Casey included in the report? So let's see. Add an explanatory paragraph below the opinion paragraph. So is that required? For publicly traded companies, yes, it is. Okay, it is. Okay. Modified wording in the basis for opinion section. Is that required? Yes, it is. Modified wording in the opinion section. That's also required. So it's dun, 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 all of the above. Yes. Okay. Do a mini celebration. We finally got to the all above for this semester. May not be the last one. Who never knows? Okay. All right. With respect to the Four Eyes audit, Casey is also responsible for receiving certain information to ensure it's consistent with Four Eyes information presented or the information presented in Four Eyes annual financial statements. Which of the following be an example of this type of information? What's the one example that we talked about in class? The one that I always point to for this particular scenario? The annual report. Okay, the annual report is an example, perfect example of this. Remember, the annual report tries to paint the organization in the possible best light that it can, versus a 10K, which is just kind of black and white truth. Sometimes blue. If you look on the 10K on the SEC website, they put blue highlights in there occasionally, but black, white, and blue, whereas everything else is sunshine and rainbows. All right, moving on. Let's go ahead and let's go ahead and move on to this so we can look at by the way, practice exam should be available if you miss any of these parts right here. Okay. So something called a control sequence, you had to recreate my diagram. Now, obviously your recreation is not going to look as good as this one. Okay. And that's fine. All right. You know, I mean, as long as you can just do honor to it, that's fine. It's not going to look nearly as pretty, but you know, this is what it should look like. You should actually have all the components listed there. Briefly explain the diagram. Again, our organization implements a control in response to a risk, which we characterize risks according to assertions. We are responsible for testing the controls. I can't emphasize this enough. It will not be as relevant on this exam, but it's very important to remember. All of these steps should align, okay? You can't just randomly say, I've got a control and it doesn't relate to the risk. You can't just randomly say, I've got a test of control, but it doesn't relate to the control. Everything should be consistent with one another. So keep that in mind. Again, not terribly relevant for this exam, but very relevant for the next upcoming exam. COSO internal control integrated framework specifies 3 objectives. Which of these are most relevant to financial statement audit and why it's most relevant? So we have 3 objectives. We got reporting, operations, compliance. We all identified that reporting is most relevant. Why? Reporting is what generates financial statements, and we're there for a financial statement audit. So we're very concerned about controls that are relevant to the financial statement audit report generation. Controls are great, but they're not perfect. What are the 5 controls are subject to certain inherent limitations of their effectiveness? What are 3 inherent limitations? Okay, 3 things that I love to talk about. I spent 10 minutes talking about it because I love them so much. Management override, errors or mistakes, collusion. Not only should you know those words, you should probably be able to do practical explanations for those. We talked about examples of those. Remember, management override was the Taco Bell cash register. Errors and mistakes was the McMillions fraud, and collusion. Who was I say? Anna and Tommy that were cheating together. Okay, I'm gonna have my eyes out for you on this exam. Okay, actually, now that's subtle today. Now you need to pair up on somebody else. That way, I won't be paying. So yeah, you can work with anybody else in the room to collude. Yeah, all right. Look, he's giving us permission to collude. Actually, I don't know how I feel about that. If you got away with collusion in my class, I'd be kind of like, good job. Well done. Well done. All right. Assume you've been assigned to sample testing of clients' internal controls. Okay. So whether it's operating effectively or not effectively is what you have to tell me about. So basically, you have to tell me what's going on here. So first thing we need to know is we're comparing to tolerable deviation rates. We're comparing the upper deviation rates to this number. But you will notice that in this problem, I did not give you the upper deviation rate. Did you have to calculate it? Yes. Now, you would say, are we going to need calculators for this exam? You probably should have them handy, but this was not a particular complex calculation. I did make them round numbers pretty round, okay? So how do we calculate that? Well, first thing, we need to know what the sample deviation rate is. So if there's 3 deviations in the sample and a sample size of 100, that's going to be 3%, okay? So then we actually add the allowance for sampling risk, which is 4.5. 3% plus 4.5% is 7.5%, which is less than our tolerable deviation rate. So the control is effective, okay? Same process over here, okay? 4 divided by 100, 4% plus 4, 8%. 8% is greater than 6%. The control is not effective, okay? 6 divided by 200, that's 3% plus 4.2%, 7.2% is less than 9%. So the control is effective. That's all there is to it, okay? So a little bit of math, but it was not particularly complex math. I figured everybody could do that in their head. If I can do it in my head, you can do it in my head because you guys are much younger and much smarter than I am. All right, everybody ready to go here? This was the fun part, right? This is where you got to really test your knowledge. By the way, I do want to throw out a comment, okay? So I didn't intentionally do this. I meant to add a statement. This will be on the exam itself, okay? I said the explanatory paragraph is duly excluded, and this is in your version that I call for as excluded. I also meant to tell you the firm's written signature was deliberately excluded. So if you identified there was no signature, you're technically correct, which if you are a Futurama fan, that's the best kind of correct. But that was not one of the answers I was looking for. So I will tell you specifically if an item was included or excluded on purpose. So make sure you read that line. It's going to be highlighted in gray on the exam. It's going to be right down here after this statement, identify the 5 errors in the report. Make sure you know everything that was deliberately excluded because that's not a possible answer, which I've been cursed out for that because somebody thought they identified something on a previous exam and then they called, actually not cursed out, that was a mild curse out. They said, darn you. So, all right. So what do we got here? Let's look. Okay. So I know we got 3 minutes, but it won't take a lot of time. So, this is a disclaimer of opinion. And what do we know about disclaimer opinions? Did we perform any auditing procedures? Well, we kind of probably did, but we don't say that. So what's the wording here say? We were engaged audit, not we have audited, we were engaged audit. So that had to change right there. Okay. Next, so we had just a disclaimer opinion. Anything missing before we move on to the basis for a disclaimer opinion? We have to explain why we issued the disclaimer opinion. We have to have a paragraph here that says, here's the issue, here's all of its details, here's why we think this is important. It's a material deficiency, and that's the case. So every time we have something other than a unqualified opinion, we have to add a paragraph explaining our departure from that opinion, or at least a paragraph, sometimes more. Okay, but there's nothing down here, so that's missing. By the way, that first error was worth 2 points. This one's worth 3 points. Okay. Moving on. Anything in the this section right here that jumps out to you? Okay. So it looks like pretty much all the information that's in the standard unqualified report, right? But it's not an unqualified opinion. So should something be struck? Our responsibility, yes, this sentence right here, our responsibility is to express an opinion on the finding statements. Why should that be struck? We didn't express an opinion. It's a disclaimer opinion, so that has to go away. That was a 3-pointer, by the way, too. Okay, what about this paragraph right here? You like this paragraph right here? What is this paragraph called? What did I call this paragraph, by the way? The scope paragraph, okay? Disclaimer opinion by definition is a scope limitation. So if we were limited in scope, should we have our scope paragraph? Nope. Just get rid of that. Just get rid of that altogether. That's 2 points. What else is missing? Obviously the signature, I know that, but what else is missing? The audit report date. We have to report the audit report date, which is not given there. That was a 2-pointer. So just a reiteration, just real quick to review, okay? We were engaged audit was listed up here, 2 points. No paragraph down here that said they explained the reason for the disclaimer opinion, that's 3 points. Our responsibility to express an opinion should be struck. I should technically strike that out. Had to be struck, that's 3 points. And then the scope paragraph had to be removed because we had a disclaimer opinion has to be removed, disclaimer opinion, that's 2 points. No date, that was also 2 points. So there's 12 points right there. Yes. You don't have to explain like in context, like you don't have to say like scope opinion merit should be removed in a disclaimer opinion. You could just say scope paragraph should have been removed. Yeah, because I'll take note. But if you just say scope paragraph, that's not sufficient.
Or on the like paragraphs in the test, or do you want us to write it again at the bottom?
I would like it to have it in there because it's a little bit clearer if you explain it. But if you want to put it in both places just for reiteration, that could be helpful because then I could, if we go back and I say I identified this, Dr. Barnes, there's just some confusion, then I can say, okay, that makes sense. All right, best of luck in your studies. See you all later.